Average Convergence and Divergence. And remember, it's sponsored by your platform provider, ETX. And if you want to know more about ETX, you can visit us at www.etx.com. And also check out our new ETX Pro Trader platform. Now, tonight's class is being recorded, and you can access a copy of this recording in about 24 hours by using the same link you used to come to tonight's class. So let's get started with moving average convergence and divergence. So before we go starting actually put it on the charts, let's get past a little bit of history. This indicator was developed in the late 70s by Gerald Appel. Now, if we all remember back to the late 70s, I'm sure a lot of you aren't even old enough to remember back to the 70s, there was only there was no online trading, and most people or most traders were trading stocks. I didn't start trading until 80 actually, and I was a commodities trader, but it was still in the pits or in a broker's office on a floor. There weren't PCs, you had computers in air-conditioned offices keeping them ice cold, but this is where trading started. And when Gerald Appel developed this indicator, it was developed for a slow-moving stock market. Okay. And it was used to spot changes in the strength, direction, momentum, and duration of the trend of a stock's price. Today, or over time, as the markets started to change, Mr. Appel also updated his indicator, made some changes in the way it is, and adjusted it to work in all current online type markets. And the MACD is one of the most popular and broadly used indicators in Forex trading. I don't know if it's used so much because it works that well, because it does work well, or because people just like the name. And you know, buzzwords in this industry work great. And people like MACD, or moving average convergence divergence. And it's something you remember a lot. And there's certain indicators like RSI and stochastics that everybody kind of knows about. Okay, but it is one of the best indicators out there. And the basic function of the MACD indicator is to discover new trends and to help identify the end of current trends. There are various ways to gauge signals generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Because MACD also serves three purposes. It will give you crossovers, it will give you, and that generates transaction signals, it will give you overbought and oversold indicators, and lastly, it will also give you divergence. So you're actually getting three indicators in one great oscillator. Now, the MACD is an indicator is typically based or put on the bottom of your chart in a separate window beneath the price charts. The moving average convergence and divergence is a relatively easy tool to use, and it really is. You'd be amazed. Well, we're going to show you how easy it is to use. However, it's crucial to understand it fully before attempting to trade its signals. Now, I'm going to apologize straight from the very beginning. And I do this in every MACD class, and I have been teaching MACD for a long time. And I have rewritten this class, I've readjusted the class, I've done everything I can to make it more interesting and exciting. But it's a problem here, because MACD is a derivative of a derivative of a derivative of a derivative. That doesn't complicate things for you, but it complicates all the things I have to explain to you, so how we end up getting down to the final indicator. And in order to understand MACD and for you to incorporate it into your trading strategy and to understand, you know, the problem with a lot of indicators is people think they're hardcore rules. When RSI hits 72, I should do that. When stochastic goes to 22, I should do this. But it doesn't. Because it doesn't work that way, because you also have to recognize all the other parts of the indicator. Was RSI at 82 and it just dropped down to 72? Or did it come up to 71 slowly and then make it to 72 and then go fall back in below the 70 level? Okay. All of these make a difference. And was the asset trending very hardly? Did some economic data come out that made the asset gap up? So you need to understand what the lines are, where they come from, so that you can avoid trading mistakes while using the indicator to the best advantage. So you got my whole apology here. So we've got some work in front of us, because the first part of MACD, it starts out pretty straightforward. It starts out with a 26-day or 26 period and a 12-period exponential moving average. Now, all of us know what a moving average is. The moving average exists in everything in the world. Okay, what is? You take 5 common things that you want to average, add them together, divide them, and that gives you the average. So if you're going to take the height of your 5 kids, you would take the height of all 5 kids, add it together, divide it, get the average height. Now, an exponential moving average is a little bit more complicated than that simply divided by 5, because an exponential moving average gives a little bit more weight to the more current prices. Because if gold was at 1250, then went to 1260, went to 1270, went to 1290, and 1290 is the most current price, and at 1260 before that and at 1270 were the most, those are more valuable than the 1250 and 1250 and 1250 at the tail, the back end of it. So an exponential moving average, when it adds it together and divides it, has actually given a little bit more weight to the most current number. Now, we're using a 26 period and a 12 period exponential moving average to start out MACD. The other thing, we're going to go over to the chart and start doing this in a second, is the biggest difference between a 12 period and a 26 period is one is a faster reacting moving average and one is considered a slower moving average. The reason being, a 26 period, a 12 period moving average is the last 12 prices. So if it was, you're looking at a half-hour chart and you're looking at the last 12 prices, that's 6 hours of trading, and it's reacting to the last 6 hours. When you use a 26 period moving average, that's reacting to the last 26 half hours, the last 13 hours. So the 12 period would be more responsive to the most current prices. It would move faster. It would adjust itself faster, because when you're adding the numbers together and dividing, you're only using the last 12 as opposed to going back 26. So the 12 is considered the faster moving average, while the 26 period is the slower moving average. So let's go over to some charts. Let me pop up the charts on your screen here. Okay. And we are looking at the euro US dollar, and only because it's the most popular traded asset in the world. We're not looking at it to make a trading recommendation or anything else. We're only using it because it is the most popular asset out there. Okay. Now, the first thing we have to do is put these moving averages on our chart. So we would just go up to our indicators and pop on moving average, and I've already set them up for us. So I'm going to click on here, and here is my 12 period moving average. I put it in red so it's easily visible to you, and it's just a 12 period simple moving average, or EMA actually, of the euro US dollar. Put on a chart, nothing complicated, really pretty basic. And then we put on the chart a 26 EMA, a 26 period moving average, and I put that one on green for you. Now, the fact is, if we were just using a 12 and a 26 period moving average, we're not really using MACD. We're using a moving average crossover strategy. MACD is much more advanced than that, because this is only the starting point of MACD. Okay. And actually, once we have these and have the numbers for them, we remove them from the chart. Okay. So MACD, we have a green 26 period and a red 12 period. Colors are unimportant. I just selected the colors because they look, hopefully you can see them better on your screen when I'm sharing my screen with you. You can make pink and orange, orange and red, green and orange, whatever way you want to click on the format button on your screen and set it. And we're going to look at how to do these on the ETX platform in a video very shortly, because you can also set the colors there. And they have MACD on their charts, and it's a great chart. It's just easier for me to teach class on these charts because I don't have the whole platform moving behind me. So we have these two moving averages. So this is what? The first derivative of price. So the moving average is based on the close price for each of these segments and dropped on the chart. Now, this is just our starting point, because what we have to do is MACD is placed on the bottom of our chart, not over price. So MACD will appear down here. So what we want to do is we go up to our indicators and click on MACD, and it would automatically drop MACD on your chart. Then you can customize. Now I've got it pretty well set up for us already. And the first line that's going to place on your chart is called the MACD line. Okay, not a complicated explanation or name of the line, the MACD line. Okay, what do you think it is? Well, the MACD line is a simple mathematic, I don't even think it's mathematics, I think it's arithmetic calculation based on this line and this line. What it is the 12-period moving average minus the 26-period moving average. Okay. And all you do is subtract one from the other and then place the dot on the chart below. Okay. And then connect those dots and you form the MACD line. Now you notice down below we have a zero line. And we take and subtract the difference, and we would place the positive numbers, whatever they are, above the MACD line, and we would place the negative numbers below the MACD line, because we get negative numbers when the 26-period moving average is larger than the 12-period moving average, because you're still subtracting the 12, 20, from 26. So what does that tell you? You're subtracting a bigger number from a smaller number. So when you have the 26-period moving average above the 12-period moving average, it's going to be a negative number or down here below the zero line. Okay. Now I keep mentioning the zero line because it's significant. Because what do you think the price or the value of the 12-period moving average minus the 26-period moving average when they cross over each other? When you subtract one from the other and they're crossing over, they're always at zero. So whenever they touch the zero line, you know you have a crossover between the 12-period and the 26-period. If it crosses over, if it crosses a zero and moves above, that's telling you that shorter, the faster moving average is growing more than the 12 moving average. So in other words, we can look here and we can see that the crossover occurred here. And the price started moving up here. So we can see that the short-term moving average, the 12-period, was getting larger than or they were separating the 26-period. So this creates the moving average, the MACD line below, and by using the zero line, we can tell which one is crossing in which direction and where the asset should be going. So once we've got the MACD line on our chart, we no longer have any use for the moving average on the price chart, because MACD is not placed on the price chart. MACD is placed below. So this blue line is all the information that was contained in those two moving averages. So now we have, our first derivative was the moving average, because that's the first step away from price. Then we have the MACD line, which is the difference between the 12 and the 26, which is our second derivative. But that's just the beginnings. From here, we go put another line on our chart, because if we were trading simply the crossovers between the 12 and 26, even if it was on the MACD line below, we're still trading a moving average crossover strategy. Okay. Again, we need something a lot more advanced than that. So Gerald Arpel then developed the second line as part of his formula, which is called the trigger line or the signal line. And this is the line I just dropped on here. This signal line is, and this is a very boring explanation, I'm sorry. The signal line is simply a moving average, a 9-period moving average of the MACD line. So all you do is take the last 9 MACD numbers that were put on the chart, the difference of the MACD from above down here, place it on this chart, and then you average it. You take 9 periods and average it together and put that dot on the chart, and that forms your signal line. Now, I don't know exactly where 9 periods come from. All we know is that Gerald Arpel tested this for years and tested, back tested, retested, and this is the formula he came up that works successfully. So you start with a 12 and a 26 period, and then you add on a 9-period moving average of the difference, and that is placed on as what is called the signal or the trigger line on the bottom chart. Now, once again, when the signal line crosses over the MACD line, guess what? It always crosses at 0. Whenever two things cross, they're equal to each other, so the difference is 0. So whenever the two lines cross, we know that they're 0. If they cross a move above, we get one signal. If they cross a move below, we get another. So what do we have now? We have a derivative of a derivative of a derivative. But now we're starting to get something that gives us trading signals. The first part are the transaction signals. But we're not done putting MACD on the chart yet. Okay. So we're going to continue with the last step. And the last step is called the MACD histogram. And the histogram is simply a bar chart that is calculated on the difference between the MACD line and the MACD signal line. So it's the difference between the red line and the blue line. And then that is plotted above and below the 0. So when we see the histogram move to 0, we know the lines are crossing. When the histogram moves up and over, we know that the MACD line is faster than the signal line, or we're getting an up indication. When it's trading down, when it falls below, we're getting a sell indication. We also then can start developing some relationships between the shapes and the depths of the peaks and the valleys here as compared to price. Because here we have this shallow valley while we have price moving upward. Then we get this peak up in price, and then it starts falling below these lines. Although it's not generating signals for us, what we can see here is very obviously divergence, because the indicator is making lower highs while the price is moving in upper highs. So we have crossover strategies with a zero, and we have divergence. Then we have the last point that we're looking at, and when we see these large loops in price, this is also telling us that the asset is overbought or oversold. So when we see the asset push far down like that, it's telling us the market is oversold. When we see it push way up, it's telling us the asset is overbought. Now we're going to explain that a little bit more. But here we have a moving average, two moving averages subtracted from one another. Then we take the moving average difference and average that. And then we subtract them from each other and we end up with the histogram. Okay, so that's a mouthful. But now you know where these lines come from. Okay, you understand what the lines are, how they've been derived. You understand what the histogram does, because technically, I don't ever look at these lines anymore. Most traders that use MACD only use the histogram, because the histogram has brought in all of that information and put it in one easy visual formula. But when you drop the indicator onto the charts, it gives you everything you see right now. So you never have to calculate anything anymore. Now, the fact is, it's a great indicator. It's easy to use, easy to see, easy to explain. So what I'm going to do is I'm going to run you a short video that's going to give you an explanation, about 1 minute long, that's going to show you again, now that we have it on chart, where to start looking to recognize. And then we're going to go back and look at some more live examples. So give me a second. Let me get this video. And this is done. We did this at ETX. So let me pop it up there for you. And it's also going to show you how to set the indicators on your platform, so you can use them when you're actually trading. I'm sorry, I did it again. I ran the wrong video. I don't know why the titles are backwards here. Here we go. All right, ladies and gentlemen. Now, anytime you want to watch that little video, you can just go to the ETX Pro, the ETX Capital YouTube channel, and you can find that with more education videos there by just going to YouTube and looking up ETX, and you'll see all of our daily reviews and also our education series and also how to use the platform correctly. Now, MACD tells us three different stories. It gives us moving average, convergence, and divergence, which comes into crossovers, overbought and oversold indicators, and divergences. Now, we briefly touched on the three of these, and you're not going to learn and master this in one class. It's going to take a while. But the basic MACD trading rule is to sell when the MACD falls below its signal line. Similarly, a buy signal occurs when the moving average, convergence, divergence rises above its signal line. It is also popular to buy and sell when the MACD goes above and below zero, which I told you was the difference between the signal line and the MACD line. So we're simply looking, if you want to make it easier, for the above and below zero, okay, or the crossovers. So here we have a crossover. We have the zero on the histogram, which is just the difference between those two. And we can see this is the point we would have wanted to enter, or we got a transaction signal to sell. Okay, here we get the zero crossover again, but it crossed in the opposite direction, so it gave us a buy signal. Now, you're not looking at the crossovers on the moving average on the charting indicator. Those are simple moving, the EMAs we started with. You're only looking at the crossovers on the MACD and the trigger line or the signal line below. Because looking at the crossovers on the 12 and the 26 period EMAs is simply a basic moving average crossover strategy. And if you notice, the MACD line down here is a lot more accurate than the close because these don't appear at the same point. You see here, the MACD line gave you the crossover and told you to enter the market and to sell. You didn't get the crossover, the moving average to here. You would have been a little bit late for the markets. So you're looking at the crossovers down below here. Now, a bit of warning. MACD doesn't give you or doesn't have any information in on how far that movement will go. So it generates a lot of what I would call false signals. A false signal is not necessarily that it gave you an incorrect signal. MACD doesn't calculate the spreads or the buy and ask position. MACD tells you to enter the market now, not when you actually entered the market. And MACD doesn't tell you how far it expects that move to go. So a lot of times it's telling you completely correct. The trend is over, the price is moving in a direction, but it's not, it doesn't go far enough for you to have covered your spread or make any profit. And the next signal could be like here, you had very tight buy and sell signals. So the MACD, you have to use risk management, okay, maybe another indicator, support and resistance lines, and you have to look at the trend, not to blindly trade from these transaction signals that say buy or sell, because they're telling you it's a buy alert. It's saying, okay, it's time to buy. Now make your evaluation to see if you want to make a trade. Now MACD also gives us overbought and oversold conditions. Now remember, overbought and oversold doesn't mean buy or sell. An overbought market or an oversold market can remain overbought and oversold for quite some time. It just tells you that the price or the price rally or the price movement is unsustainable. And it's not a point to be entering a trade. And when the market reaches overbought, you should, if you have an existing position, be getting ready to exit the market or set your stop loss or your exit points. And it's not telling you to enter a market. It's telling you that the current trend is too heavy. It's too weighty, and it should have an adjustment. We get this from MACD, as I showed you briefly on the chart before, in the depth of these signals. When we get very, very high depth, or if you look at the peaks and the valleys on the histogram, when they're extremely high or extremely low, that's telling you the market conditions are either overbought or oversold. And then lastly, we get divergence. Divergence is a very good indicator, except it's a very difficult indicator to interpret. So an indication that the end of the current trend may be near occurs when the MACD diverges from its symbol. So in other words, the MACD line on the bottom chart is moving opposite of the actual price symbol. So here, if we were to draw a trend line from the lows of the MACD, we see the MACD is making higher lows, where the price is falling in a downtrend, making lower lows. So what we see is the indicator is moving in an upward angle, and the price is moving in a downward angle. Now, it happens to be we got a crossover here after the divergence, which also gives you a very good, that compounds that buy signal. Here's we got the price breakout, and you could have traded this rally, but if you notice, it wasn't a huge rally. Sometimes it's big, sometimes it isn't, but it definitely told you this downtrend was definitely over. Okay, so even though you're waiting for the price, ease, push, ease, push, ease, push, at this point, when you got that crossover and the divergence, you know that that rally or that downtrend has ended. So you have three different ways to interpret this market. Okay. Now, me telling you this and you learning and understanding it are two different scenarios. I can point out to you the things that you can use MACD, but it's going to take a little bit of time, a little bit of practice, a little bit of reading and learning to how to use MACD properly to spot these opportunities and how to evaluate these opportunities. But remember, the actual ultimate histogram is a derivative of a derivative of a derivative of a derivative, which means a derivative is each time it moves a step away from the actual price. So we start out with the 12-day EMA and the 26-day EMA, which is what we plotted on the charts. Then we go to the second derivative, which is a second adjustment step away from price, is the MACD line itself, which is the difference between the 12 period and the 26 period. Then we go to the third derivative, which is the MACD signal line, which is a 9-day EMA of the MACD line. And then we go to the fourth derivative, which is the MACD histogram, which is the MACD less the signal line. Okay. Now, moving far away from price isn't a bad thing, because what it's doing is analyzing all of that price. Because remember, price is erratic. I mean, one of the reasons we use moving averages is to try to take the noise out of price. Well, what this is doing is interpreting the movement of price, the momentum and the price movements, to make sure or tell you what you're seeing in that price. But MACD is serving many purposes, and the fact is MACD is very reliable. And when it issues those transaction signals, again, you'll get false signals, but you won't get wrong signals. Okay. So it's a good starting point. And you can start out by only using one part of this. You could just use the transaction signals. Now remember, they are only buy and sell alerts. They aren't go in the market and do something. And MACD doesn't help you decide where to take profit. It doesn't help you determine where you want to put your stop losses. So it gives you overbought and oversold, divergence, and buy and sell transaction signals. So it must work with other indicators, trend lines, support and resistance lines, and something that's going to help you do one other indicator that will help you do evaluation. But to use another overbought and oversold indicator is almost redundant. To use another one that can give you buy and sell signals might help if it helps define the entry point. But what you need is something that's going to help you decide whether it's a good signal and how far that asset should move. Okay. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. You'll be able to watch a recorded version of tonight's class by using the link you can't use tonight. And you can see a copy of that YouTube video around for you by just going to the ETX YouTube channel and pull up the MACD indicator education right there. And it'll all be there for you. So thank you very much. Have a great week, and I'll see you again next week. Now, if any of you notice, we've added 4 more cryptocurrencies to the platform. May the 1st, we're going to have a special webinar to look at the differences between cryptocurrencies and how you'd understand how each one gets its value and how you can determine what they are and why they are. So because there's a big difference between Bitcoin and Ethereum, there's a big difference in the values and how they move differently. So hopefully we'll see you on May 1st for that class. We have a nice schedule. They'll be hosting the May schedule any day now. And we'll see you on next Tuesday. Have a great week. Bye now.